Hi everyone, it is Monday the 11th of December, and that means it's time to take a look at what moved the markets last week. The prevalent theme driving the markets at the moment is that central banks such as the ECB, the Fed, the Bank of England will begin cutting rates next year, potentially as early as the second quarter. This has manifested itself in a few different ways: the US dollar weakening, the price of gold rising, and small caps rallying. But if you look on screen, you can also see that the NSDQ100 for the last week has risen by about 1%, as has the S&P 500. The expectation now is that the central banks, probably starting with the Fed, are going to throw cold water on this theory as early as this week. But let's talk about that a little bit later. Last week, we saw a lot of US-based employment data hitting the market, various ways to slice and dice this data. For example, on screen you can see that job openings within the US have been declining fairly rapidly through the past few months. And as you would expect, the number of people making jobless claims has increased through the same period. We've also seen the unemployment rate ticking up, although by less than was expected this time around. And the reason that these numbers are so closely watched is because investors know that the Fed is looking at this data, wanting to see some of the heat come out of the US labor market. The reason for this is that a cooler labor market means that fewer people are able to participate in the US economy, thereby helping inflation cool down. The problematic data point in the set that we received last week is now on screen, non-farm payrolls. And it was expected that this number would come in at 180,000, but it's come in at nearly 200,000, meaning that the job market is still a lot stronger than most people expect. This has many people, including me, scratching their heads. The traditional relationship between high rates and a slowing economy seems to have not really worked this time around, particularly within the US market. The two sides to the coin are that the Fed is likely to keep rates higher if the labor market continues to be strong, and at the same time, a strong labor market gives the Fed more room to maneuver in bringing inflation down without completely destroying the economy. So the short-term bad news is probably going to have higher rates for longer. However, a soft landing is also more likely. Another very interesting thing going on in the market at the moment is that the price of oil has been falling for some time now. We can see this little jump in the price, and this happened when the conflict in Israel first kicked off. But you'll also notice that shortly after that, it continued to fall and is now back to the price that it was back in September 2018. In the same way, if we look at the price of natural gas, we can see that it went through the roof, as I'm sure everyone remembers, but has collapsed quite sharply and is now back at fairly normal levels. The reason that this is interesting is because the price of energy is a huge contributor to the levels of inflation. And just like when these prices were rising, they drove inflation up. Now that they are falling quite sharply, they will really help in bringing inflation back down. Data points like these make it incredibly difficult to predict where the economy and central banks are going to go with their decision making. That's why instead of making short-term or even medium-term bets on the direction of the economy or other macroeconomic indicators, it is a much better idea to be a long-term investor. Find companies that are performing well, have a history of doing so, make sure that they're reasonably priced, and invest in those businesses. One of my favorite companies at the moment, and one that I talk about fairly frequently, is Canadian Solar. This is a solar business that sells to other companies. They manufacture and sell solar panels as well as energy solutions, but also execute the projects to deliver these to companies and sometimes utilities, so companies that provide electricity for municipal government areas. There are many reasons why I like Canadian Solar as a company and as a stock. The share price of Canadian Solar has fallen quite dramatically. It's down 33% on the year, down nearly half from its highs through this year. And part of the reason for this is that people often borrow money in order to execute these types of projects. The cost of borrowing money is quite high, and so the number of these projects being executed has dropped quite a lot. Canadian Solar fell the most on the back of earnings from other companies that seemingly do similar things to this business. However, the bulk of those companies were solar businesses that sold to the end consumer. When you sell to the end consumer, the value of what you sell tends to be smaller versus selling to other companies. The projects tend to be shorter, and therefore there is more volatility in the revenue and therefore earnings that you're able to make as a company. So even though Canadian Solar has been impacted by interest rates, The solar companies that sell to consumers had an outsized effect on Canadian Solar's share price when their share prices fell on the back of their earnings. Now, this is not me just weaving a yarn. If you look at the numbers of Canadian Solar and you go into a lot of detail, we're not going to do that now. We'll just look at them at a high level. You'll see, for example, that the business has a great PE ratio by the various measures that are available to you. The PEG ratio is 0.05. The earnings of this business are growing much faster than the price that people are willing to pay. Another thing you'll notice going down this column is that CSIQ Canadian Solar versus the sector median it's dramatically lower. It is significantly cheaper than the sector median. At the same time, if we jump from valuation to growth, you'll see a similar story for the various measures of growth for this business and when it is compared to the sector median. In terms of profitability, obviously the red marks jump out at you here. The gross profit margin is lower than the sector median. However, by most other measures of profit, this company is better than the sector median. As an investor, it's also very important to follow the news that companies are putting out there. And this is not a comprehensive list. It's just a nice consolidated area to look at those headlines. You can see that Canadian Solar is winning project after project, large-scale projects. So when I say you shouldn't try predict macroeconomic indicators and their short-term influences on the stock market or whatever assets you're looking to buy, instead buy good companies. Canadian Solar to me is a good example of that type of a purchase. It's a company in a growing area, highly successful at winning business as it's proven for decades now. The stock price is cheap, the revenue growth is good, earnings have taken a bit of a hit because there are high interest rates at the moment, but there won't be high interest rates forever. So because of all these points, Canadian Solar is one of my largest positions, and I'm always looking for other companies like this, despite the economic conditions. Now, what's going on this week? Well, things are going to slow down as we move towards year end. However, this week is a huge week for macroeconomic data. We can see that within the US, we're going to get inflation numbers, the CPI numbers, as well as the PPI numbers. We'll also get the core retail sales number, which will tell us if the consumer in the US is still spending. We'll get another labor market data point in the initial jobless claims number. And we'll also hear about the UK's GDP growth, if there is any, as well as the Bank of England, our central bank's interest rate decision. Despite this flurry of data, undoubtedly the most watched data point will be the Fed's statement. So the Fed's interest rate decision will be interesting, but the statement will be the most closely watched item. The reason for this is that the price of various assets within the market are based on where the market thinks various variables are going to be in the near-term future. Many asset prices have been rallying on the back of an expectation that there will be an interest rate cut, probably around the halfway mark next year. But given data points such as the non-farm payrolls number that we saw last week, there is a chance that the Fed decides to be more hawkish than it has been in recent meetings. If this is the case, we could see assets that are most sensitive to interest rates tumbling in the short term. All right, that's it for this week. I hope you have a good one. Speak to you soon. Goodbye.